was one other investment strategy that you did in there as well, which I believe was south of the border. Can we talk a little bit about your experience investing in the U.S.?
We have to.
I think it would be great for our viewers.
We made 5 investments in the U.S.
Okay.
They all lost money.
Hey guys, welcome to the show. We're here with Mr. Steve Aho. We're going to dive into real estate, private lending, and different ways that we can make wealth, build wealth, and preserve our wealth. So, Steve, how are you today?
Good. How are you, Kyle?
Wonderful, wonderful. Good. Well, I wanted to have you on today because I want to talk a little bit about your journey in real estate, how you got into it, the type of investing you do, and what kind of the next steps are. So sure. Let's start with how'd you get into real estate?
So 10 years ago, 2015 or so, my wife and I decided to go to a Keyspire event.
Okay.
And in that Keyspire event, we decided to become members of Keyspire, and from there, when we had decided, we said, geez, we got to do something. So what did we do? We started to try and do everything.
So just to start, so Keyspire, for those who don't know, that's Scott McGilvery, Michael Saraceni,
yep.
Real Estate Education Company.
Right.
And because my understanding is you guys were doing pretty well. You guys at your age, what inspired you and Ruth to go to this real estate conference in the first place? Before we talk about all the things you did, what brought you there?
That's a really good question. We wanted to get our mortgage paid.
Okay.
And we were looking for ways to do that. But then we discovered that maybe paying off the mortgage isn't the best idea. I had some heart trouble. I was going to work in the dark, coming home in the dark. Ruth was staying home with the kids. And we just wanted to get the mortgage paid down. And she was a realtor, and she thought, why don't we go and hear what Scott has to say? Maybe we can learn a thing or two about how we can improve our financial situation. So that's what brought us there.
So you went to an event to learn how to pay off your mortgage.
Yep.
You paid for additional education to teach you how not to pay off your mortgage.
Exactly.
Got it. Okay. Yeah. So then just want to make sure we're on the same page here. Then you got shown a bunch of different stuff. Yeah,
we were taught a whole bunch of different strategies.
Okay.
Most of the focus was around owning rental properties.
Okay.
So we thought, well, let's try our hand at that.
Okay.
Do we really want to be real landlords? And so we got involved in that to a very limited extent, because we discovered very quickly we didn't want to be landlords. So we bought a single family home. We ran it for 2 or 3 years. We dealt with the nuances of being a landlord and professional tenants and how they behave, and we quickly discovered that we didn't want to do that. So that was a strategy that we thought we would try. Didn't work out, although we did make decent money when we actually sold the property. We also looked at some passive lending opportunities, so we got involved in some land developments. We got involved in a little bit of passive investing, and then quickly discovered that really our goal was to focus on passive short-term lending opportunities.
So let's dive into the passive investing, because if you listen to a lot of the real estate gurus, they'll tell you that owning a rental property is passive income. Was that your experience?
No. I mean, I didn't want to deal with the tenant. Ruth did that.
Okay.
And we would get book-long text messages about things that they didn't appreciate, or they wanted more of, or things just weren't the way they wanted it to be. And Rent was late. We were always chasing rent. We didn't have a whole lot to do with the property until the one big tree on the front lawn came down in a windstorm and almost hit the house, and we had to deal with that.
Okay.
So there was more to it than we ever imagined.
Yeah.
And even when it was time for him to leave, Ruth and I went, because that's the type of people we are, we went stem to stern through the entire house and cleaned the entire house so that it was ready, better than swept clean.
Okay.
It was really good for the new owner coming in that bought the place. So there was a ton of work, way more work than we ever expected. And that's just for one single family turnkey property.
Yeah, so this wasn't even a property that needed work.
No.
This was, you bought like almost like a flip from somebody, right? It was done. It was turnkey.
Yeah.
Okay. Yeah. So you did the rental property. Yeah. Didn't love that. Concurrently, you were doing some other more passive investments, and talk to me a little bit about these passive investments. What were they? So
specifically, they would be what we learned were equity positions, okay, land developments, basically taking moderate or modest amounts of money, $25,000 at a shot, and putting them into, it turns out we have 7. I say we have 7, so that means we still have them. And this was back in like 2016, 2017, where we were taking registered funds, RSPs, TFSAs, that kind of thing, putting it into these longer term equity land developments. So we actually have a bit of an ownership stake in them. Okay. The rates of return were in the sort of 20 to 30 range at the time. And of course, that looks tremendously attractive when you're thinking, oh, I can make that kind of money on my money. Well, what we didn't factor was you're not getting cash flow.
So it's a 7-year deal, yeah, at 20%, maybe up to 30%
per year.
But there's no monthly payments. There's no compounding return.
Right.
What if you need a couple bucks?
You're not touching it.
There's no liquidity. So no liquidity in these investments. Okay.
Yeah, and it was only after, I have to come back because we were so excited about making this decision to get involved that we felt we needed to get into something. Well, when you get into something, you don't always learn about, at least we didn't. And in hindsight, knowing what we know now, we wanted something, given our stage in life, we wanted cash flow. And these investments aren't providing us with cash flow.
So, and we're going to start talking about the investments that do provide you cash flow. Yep. But I want to hone in on 2 things. So you partnered with major land developers.
Yep.
And to build 40-story skyscrapers, big land development.
Yep.
And that was less work than owning a single family rental?
Fair. Yeah, because you're filling out some paperwork and transferring some money, and yeah, you're done.
So I do think that's a great example of the economies of scale of working with the right professionals. That when you can own 100% of something like a single family rental, yeah, or you can own a little piece of a lot bigger pie and work with the pros that can take care and execute them.
Yep.
So before we talk a little bit about the other passive investments that you've alluded to, the private lending, there was one other investment strategy that you did in there as well, which I believe was south of the border. Can we talk a little bit about your experience investing in the U.S.?
We have to.
I think it would be great for our viewers to hear a little bit, because I want to be clear about this. I'm excited about what's going on in U.S. investing right now. I think there's a lot of great opportunities in the U.S. But I don't think great would be a word that you would use to describe your experience in the U.S.
No. We made 5 investments in the U.S.
Okay.
They all lost money.
They all lost money. Okay.
4 of them were in the strategy that people refer to as land banking.
Okay.
So you basically buy lots inexpensively, sit on them, and expect them to appreciate. In hindsight, that's speculation. And depending on where you buy, all sorts of things can not work out. Now, fortunately, it wasn't a ton of money. I mean, these lots could be purchased for $7,000, $8,000, in some cases $4,000 in Florida. We ended up selling them. I think we lost money on all of them.
Good.
And then the other strategy was a trust deed in St. Louis on a property that, now knowing what I know exactly what happened. We decided, a trust deed is similar to a mortgage.
Okay.
It's just called slightly differently in the States, but we invested $40,000 US. We received our monthly interest payments for 3 years. In hindsight, it was probably our money that we were getting back. And then it came time to pay out that money. Well, when it was payout time, we discovered that the property was only worth $7,000 or $8,000.
Okay. So you were highly you were over leveraged on your security.
Yeah, huge. And yeah, it was quite an experience because there were an awful lot of players involved in this.
So that was a passive investment for you. You weren't managing this property, it was a loan.
Right.
When you went to recover your loan, you actually did have to take a more active role at that point. You had to hire a realtor, and
we spent 6 or 8 months trying to get that money back.
So, and I guess that the message I wanted to hone in on here is, like with any strategy, it's not private equity with land development is great. It's not single family homes are great. It's not investing in the U.S. is great. It's every single scenario is unique. Every deal is unique.
Yep.
There's a lot of broad strokes being painted of, you got to go to the U.S. It's the best. It's the best. Well, there are many people having great success, and there are people who have had not so much success. So we've talked a lot about the stuff that maybe didn't go so well, or some of it didn't go so well. Some of it maybe just, as you realize, it's not that the investments aren't performing, they just didn't necessarily align with your goal.
Well, that's the most important point.
And that's what I talk about all the time with my clients. There's lots of great investments, but if it's not aligning with your goal, you're spinning your tires. So talk to us a little bit about what strategy you focused on and where you've had a lot of success.
So fortunately, we were able to figure all of this out in a relatively short period of time. Probably 2.5 years, we figured out that cash flow was really important. I mean, I'm 69 now. When I started, we were 59, probably late to the game. Ruth is 8 years younger, so she's got a little bit of time on her side. But the neat thing is, it doesn't really matter at what point in your life you get involved. If you go with the strategy that aligns with what you need, there's something in real estate investing that's there to help you do that. And the biggest thing for us was taking the resources that we had, be they cash, be they registered funds, we directed them in short-term mortgage lending, in secured position.
And I want to be very clear on this because people are starting to blend these terms. Steve did not just say private lending. mortgage lending, registered, untitled, secured against an asset.
Yep.
Now that being secured against an asset isn't a guarantee, but it's recourse. In the event of a default, there's a physical piece of real estate that has a marketable value that can be sold to help recover funds.
Yeah, and I mean, the strategy is to sell the property in the case of a default. Well, the value of that property may not be the value of the mortgage. Could be more, could be less. And, you know, in the one case you win, in the other case you're going to lose some, but you're not going to lose it all.
Especially in first position.
Yes.
The odds of a 100% loss are, I don't want to say impossible, but highly improbable. Like if you're in first position on an asset, even if it drops 50% in value, you're still going to get,
Yep.
50, by that math, 50% of your money back, right?
Right.
So you've done a lot of these short-term lending, and you had a fair number of them.
Yeah.
Which can, the lending itself is passive, but you're now in the mortgage business, so it's not, you don't have to deal with the property, but there is still work involved, right? You have to pick your deal, you have to vet your deal, you have to sign the paperwork, you have to run to the bank. If there's an issue or a problem, you have to review with legal, you have to review with your broker. You have to, once you've collected all your money and interest, you have to use your documents to file and claim your tax returns. So there is quite a bit that goes into it. And I mean, we're not talking about daunting work here. We're not talking about, you know, physical labor, but there is some organizational.
Well, that's the key. You've got to be organized in order to do this properly.
Okay.
You know, Ruth and I have developed a couple of systems that allow us to track maturity dates on mortgages so that we know when money is coming free. And then, you know, we're talking to, well, sometimes I talk to myself, sometimes I talk to you about where's the next deal.
Yep.
So that, you know, when the money comes available, we can put it into another one. But from an organizational perspective, you do have to spend, I want to say, given the resources that we've got invested in mortgages, we spend time on it probably pretty much every day. But it's not like we're spending 8 hours a day at it. You know, we might spend half an hour talking about it every day, about when's this money going out, when's this money coming back.
And you're, like, as you mentioned, you have a number of mortgages now. You guys have almost, with your personal financials, you're a little mortgage company internally that you're.
Yes, I never thought of it that way.
Yeah.
Yeah.
So speaking of a mortgage company, you guys, being your experience, being everything that you've done internally, we've obviously brokered many deals for many other clients.
Yep.
Steve and I have partnered with two other partners as well on CapGap Mortgage Trust.
Correct.
And when I originally brought the idea up to you and explained it to you, I guess maybe tell the audience here a little bit, what is CapGap, and you know, how can we help our investors, and how has it helped you guys start to streamline what is already a passive investment to be a more passive investment, to take that half an hour of work that you're putting in a day and compare your CapGap time versus your mortgage time. Like, how much are you spending on your mortgage investments versus your CapGap investments?
So we probably should distinguish between a mortgage trust, CapGap,
Yep.
and a syndicated mortgage or a direct, what a direct investment is. And when we first started, the only thing I really knew about investing in from a mortgage perspective were syndicated mortgages. And so synonymously, we're going to refer to those types of mortgages as syndicated or direct investments. CapGap is different. And the way I try and explain it is, CapGap is a pool of mortgages, and people can invest their money into CapGap. So they buy shares in CapGap, So say they buy $100,000 worth of shares in CapGap. So now they've invested $100,000 in CapGap. CapGap then turns around and lends that money to the same set of borrowers that we have been lending money to on the direct syndicated side. Okay? So hopefully that helps to explain sort of the difference between the two. Now, when an investor comes to us and says, I have this $100,000 to invest in CapGap, they're going to want to know what their returns are. The returns are 8, 11, and 14, depending on the loan to value and mortgage position. Obviously, the lower the rate, the lower the risk, and it escalates from there. When they, after they've invested or the money gets lent, then they start receiving a distribution, and that distribution is an interest payment that they get.
Yeah, okay. So, and are the 8, 11, and 14, are those guaranteed returns?
Never.
Never.
Never guaranteed. They're projected returns.
Targeted?
Targeted returns. Our goal as trustees of the funds is to exceed those. That's what we wanted.
So, and the 14%, are people going to expect 18, 19%?
No. I mean, it should travel between 14 and 15, or 11 and 12, or 8 and 9, somewhere in that ballpark. So
CapGap is an income fund, so it's designed to give consistent income.
Correct.
So our goal as trustees is not to blow these returns out of the water, but to consistently maintain those targets. So if you, let's say you put $100,000 in a direct syndicated mortgage, and you have to do that over, it's a 1-year term, and you're going to turn that money 3 times in a year. Could you compare the work and energy that would go into that versus a $100,000 investment into CapGap over 3 years?
So if we put $100,000 into CapGap for 3 years, there's no lag. Your money is always working. Our job as trustees is to keep that money working. If you're on the syndicated or direct side of things, at the end of the first year, I have to be talking to you about another deal. So I have to be managing around the maturity date. Okay, when's that money freeing up? Where are we going to put it next? And then at the end of the second year, I've got to do the same thing. So I'm always managing where is the money, where is the money going? In CapGap, you basically set it and forget it for a period of 3 years.
Great. Okay. I love it. I love it. If we compare the 3 years of direct syndicated lending versus CapGap, in CapGap, you're going to have multiple mortgages.
Correct.
In the syndicated direct side, you may have well, let's use a 100K example. You have 100K in multiple mortgages in the fund.
Yep.
Or you have 100K in one mortgage.
In 123 Any Street, Ontario, on a specific property.
That's right. What happens if there's a default on the syndicated side? Do you still get monthly payments? Do you have to hire a lawyer to help assist? And we still assist with all that, but a lawyer does need to be retained.
Right.
And it could be several months before that money is recovered, before payments are resumed. What happens if there's a default on the CapGap side in one of the many mortgages?
Well, that's the cool thing. So if you take the 8, 11, or 14, let's imagine that there's, 10 mortgages in each pool. And one of those mortgages defaults. The cool thing is you continue to get your distribution.
Now, is it going to be a full distribution?
No, it could be. The likelihood is it's going to be smaller if we don't happen to recover the full value of the mortgage.
Right.
Right.
So
It's going to have an impact on the rate of return.
and if you're the investor, on the direct side, you have to you're the ultimate signer, so you have to manage it a little bit more. Like I said, we as brokers help in that scenario.
Yep.
But on the CapGap side, in the event of a default, the shareholders have no responsibility. It's all on us trustees
Yep.
to deal with it, recover, help manage renovations, all of those things.
I mean, I like to tell people that even on the syndicated side, we still do a lot of hand-holding,
Yep.
right? I mean, the activities that we spend as trustees or on the syndicated side is pretty much identical in the event of a default.
Okay.
We still do a lot of the same work. On the direct side, the lender is directly impacted. The lender knows when the default has happened. On the CapGap side, all that same default activity and power of sale, that all goes on. It's exactly the same. The difference is they continue to get a slightly smaller distribution, but they don't even really know that the default's happened.
They don't know all the day-to-day that's going on. Obviously, as trustees on our annual, on our quarterly updates, we're informing of if there is something that's gone delinquent.
Sure.
But they're not in the minutia of the day-to-day lawyers, updates, calls, site visits, all of those things, right?
Oh, and we've seen a few defaults.
It does on the direct side. We've certainly, it is the nature of the market today. And I think that's important that people understand, a default isn't like an instant panic. Depending on the scenario, like there could be great equity in the property. It could just be a timing thing that's going to result before that money is recovered. There is the other side. There are properties that are defaulting right now and the equity is thin.
Yep.
So time is of the essence. We need to move quickly. So, and that's the stance that we've taken right now. Unfortunately, when there's a default, we can't give as much grace to the borrowers.
Right.
Maybe in a couple of years ago, we'd give them a couple of weeks to help work on that solution, or a little bit more. At this point, when these are happening, we have to recommend legal enforcement right away.
Yep.
Now, we'll still work with our borrowers if they come up with a solution, a plan. We still want to help them through that.
Oh yeah, our job is to work with the borrowers as best we can.
And I think that's really important that people understand on the borrowing side, who you're borrowing money from. I'm happy to go on record right now. Anyone that we lend money to, we have no interest in owning your property. We don't want your property. There are many lenders out there that do loan to own. They're lending your money because they want to steal your property below market. I will go on record. The only interest I have is in the interest.
Absolutely.
We are looking for monthly distributions and payments. We are lenders. We want to lend money.
Yep.
And when we're lending money, we want to be able to receive our interest, to get our principal back. And we want your project to be profitable so we can then lend you money on your next project and continue to help you grow.
Absolutely.
I think this was great, Steve. If people, we're going to put your contact information in here so they can reach out. Steve, you're a mortgage agent. You're a trustee of CapGap. So if they're looking for help on a mortgage, if they're looking to invest their funds into real estate, they can reach out to you.
Yep.
And yeah.
Thanks for the opportunity.
Wonderful. Looking forward, if you guys want to reach out to Steve, send him a note. And thanks for coming on.
Thank you.